Welcome to the Opening Bell Report.
Okay, so picture this. You're the CEO of, a huge tech company. You walk up to the podium, you've got that $1 million smile, and you announce to the world that your company just brought in over $10 billion.
A record.
A record-breaking quarter. The best in history. I mean, in a rational world, the crowd would go wild.
In a rational world, maybe. But the stock market, especially when we're talking about this high-stakes AI game, is, well, it's rarely rational. And it is certainly not forgiving.
No, definitely not. That is not what happened here at all. We're looking at AMD. They post these record revenues, these huge numbers, and the market just immediately punishes them.
The stock takes a nosedive.
Yeah, and it's confusing. It feels unfair. And honestly, if you're holding the bag, it's probably a little scary.
It's the classic earnings paradox. And frankly, looking at the stack of analysis reports we have here, this is one of the most interesting case studies we've seen in a long time. It challenges a lot of our assumptions.
So that's our mission for this deep dive. We're going to unpack this whole situation. We've got a detailed analysis in front of us that breaks down AMD's earnings call, their guidance for Q1 2026, and the valuation metrics that are causing all this drama.
And we really need to answer the big question. Is the AI growth story over? Or is this just a massive, panic-induced overreaction?
It's a question of expectations versus reality, it seems.
Exactly. And to get the answer, we have to move past the headlines and really look at the mechanics here, because the headlines shout record revenue, but the stock chart is screaming something else entirely.
Yeah, it's screaming caution. So let's start with the damage report, because this wasn't just a little dip.
No, not at all. It was significant. We saw the stock fall about $7.69. That's nearly a 4% drop, closing at $192.50.
And the analysis notes it was sliding even further in after-hours trading.
Yep. So the sentiment clearly shifted from optimism to skepticism very, very quickly.
Which just feels like a slap in the face when you just announced $10.3 billion in revenue. I mean, the word record usually implies good, right? So why is Wall Street treating this like a disaster? Where's the disconnect?
It all comes down to one word.
Let me guess.
Guidance.
Guidance. The forecast. The crystal ball.
Right.
You have to remember, the market is a forward-looking machine. It rarely cares about what you did yesterday. It cares about what you're going to do tomorrow.
Investors are paying for future cash flows.
Exactly. Not past trophies.
Yeah.
And this is where AMD stumbled. The analysis highlights that for the first quarter of 2026, AMD projected revenue at a midpoint of approximately $9.8 billion.
Okay, so let's do the math. $9.8 billion forecast versus the $10.3 billion they just made. So that's a drop.
Right. It represents about a 5% sequential decline.
Sequential decline. Okay, let's just clarify that for everyone, because we hear that term a lot. That just means dropping from Q4 to Q1, not comparing to last year, right? Exactly. Quarter over quarter. Now, here's the nuance. In a normal industry, say retail or something, a 5% seasonal dip in Q1 is completely normal.
Yeah, everyone's broke after the holidays.
Right. It's expected. It's the cycle of business.
But we aren't talking about selling sweaters here.
Yeah.
We are talking about AI chips, the most in-demand commodity on the planet.
Correct. We're supposed to be in the AI hyper-growth era. The narrative, the story everyone has bought into is that demand for these things is basically infinite.
That companies will just buy everything that isn't nailed down, no matter the season.
Precisely. So the market wanted, well, the report calls it an NVIDIA-style beat. They wanted to see demand so overwhelming that it just crushes any seasonal slumps.
Instead, AMD basically said, hey, we're going to dip a little bit next quarter because of, normal seasonality.
And that just signaled to investors that maybe, just maybe, the AI demand isn't quite strong enough yet to override those typical patterns.
That is such a tough crowd. It's like getting an A when your parents were demanding an A+ cedar. Still did great, but you're grounded.
That's a perfect analogy, actually. And this brings us to a key concept from the analysis. It's called priced for perfection.
Priced for perfection. I hear that thrown around a lot. It sounds stressful.
Oh, it's a dangerous place to be. When a stock is trading at a really high multiple, and we'll get into the specifics, but AMD's PE was around 73, you simply cannot afford to be just good.
You have to be perfect.
You have to be perfect. The stock price has already baked in the absolute best case scenario, so great isn't good enough because the price already assumes spectacular.
Exactly. Any crack in the armor, any soft guidance, and PFT, the air just comes right out of the balloon.
The market looked at that $9.8 billion forecast and decided that the perfect growth story had a flaw, and that's your sell-off. It's not that the company is failing, it's that the reality didn't match the fantasy valuation.
Okay, so that explains the crash. It's that gap between perfect expectations and, well, very good reality. But let's flip the script, because if I'm listening to this and I hold AMD, I'm feeling pretty bad right now.
Yeah.
But is it really all bad news? The report we're looking at has a section literally titled, The Silver Lining.
And this is where it gets really fascinating. If you just strip away the stock price reaction, just for a minute and look at the actual business execution. The company is incredibly strong.
Okay, give me the good stuff. What are the bulls seeing that the bears are missing?
First off, that revenue growth year over year. We talked about the sequential dip, right? But compare this Q4 to last year's Q4.
Right.
The analysis emphasizes a massive 34% acceleration.
34% growth.
Yes. For a hardware company of this size, that is massive. It proves the demand is real. The AI thesis isn't dead, it's booming. Those MI300 chips are selling.
And it's not just about selling more stuff, it's about how much money they keep, right? The efficiency.
Yeah, exactly. And this is maybe the most bullish metric in the report. Gross margins, they hit 57%.
57%. And the report says that's up 300 basis points.
Correct.
Okay, let's unpack basis points real quick.
Yeah.
That's just finance speak, right? 100 points is 1%.
Basically, yeah. So 300 basis points is a 3% increase. Now, that might sound small, but when you're dealing with billions in revenue, a 3% jump in margin is enormous.
That's hundreds of millions of dollars in pure profit.
It is. And it signals pricing power. It signals efficiency. It means they aren't just selling cheap chips to gain market share. They're selling premium products at premium prices. They're escaping that commodity trap.
It sounds like they're catching up to the big dog.
It absolutely closes the gap with NVIDIA. And frankly, it puts them leagues ahead of Intel. For a long-term investor, the execution story is fully intact. They're becoming a more profitable company, period.
Plus, I saw the earnings per share. The EPS was $1.53, up 40% year over year. That's huge earnings growth.
It is. If you just looked at the rearview mirror, you would think the stock would be soaring.
Which brings us right back to the paradox. We have 34% revenue growth, booming margins, soaring earnings, and a tanking stock. We talked about guidance, but there has to be something else. The report mentions a valuation trap. What is that?
This is the warning section of the analysis, and it's crucial. The valuation trap is this idea that a stock might look like it's a discount because the price dropped.
Right.
But fundamentally, it might still be way too expensive.
How can it be too expensive if it just dropped 4%? It's cheaper than yesterday.
Cheaper doesn't mean cheap.
Yeah.
Let's look at the price to earnings ratio, the PE. This is the price you pay for every dollar of earnings. The report contrasts AMD with NVIDIA. At the time of this analysis, AMD is trading at roughly 73.77 times its earnings.
Okay, 73 times earnings. So for every dollar of profit AMD makes, investors are paying $73 for the stock. Is that high?
Well, let's compare it to the market leader, the king of AI, NVIDIA. NVIDIA is trading at about 45 times earnings.
Hey, hold on. Let me get this straight. You're telling me AMD, the number 2 player, the one chasing the leader, is trading at a premium that's almost double the number 1 player.
That is the paradox. You are paying a significantly higher premium 74x versus 45x for the runner-up.
That feels completely backwards. You pay the premium for the best in class, right?
That is the multi-billion-dollar question. Usually, a higher multiple implies higher expected growth. The market thinks AMD has more room to run. But, and this is a big but, the data, especially that guidance, shows they aren't actually growing faster than NVIDIA right now.
So you're paying a Ferrari price for a car that, while very nice, isn't going faster than the Ferrari next to it, and it's telling you it's slowing down for a pit stop.
And in some metrics, it's actually lagging. The report dives into free cash flow margins.
Cash is king.
Always. Earnings can be manipulated. Cash is reality. NVIDIA has free cash flow margins of around 45%. It's a cash printing machine. AMD, they're at about 20%.
That's just good.
It is good. 20% is a healthy business. But NVIDIA is great. And yet, the stock price for AMD is demanding perfection. The risk, as the analysis points out, is that AMD must grow faster than NVIDIA to justify the 74x PE. If they don't, the stock price has to come down.
That's multiple compression.
It is. It's when the P in PE drops because investors decide the earnings don't deserve such a high multiple anymore. That's the trap. You buy it thinking it's cheap because it dropped, but it's still priced for a growth rate it hasn't proven yet.
It's fascinating. It highlights the difference between a good company and a good stock. AMD is a good company right now, but it's 74 times earnings. Is it a good stock?
Exactly. And that premium implies a future shift in dominance that the numbers just don't support yet.
Okay, so we have a split decision. The business is executing great margins up, revenue up, but the valuation is scary. So what's the strategy? What does the report say we should watch for now?
The analysis offers some specific technical levels, because when a stock breaks a psychological barrier like this, things can get volatile.
And it broke $200. That feels like a big one.
It is. The break below $200 is technically bearish. It signals the sellers are in control for now. The report suggests watching for a test of the $185 level.
$185. So that's the next floor.
That's the first major support level. If it cracks that, the report mentions further support potentially down at $160.
Ouch. $160. That would be another, what, 15% drop from here?
It would be painful, yeah. Which is why the report advises caution in the short term. The volatility isn't over. But, and this is the key, It really depends on what kind of investor you are.
Right. Are you a trader or are you a believer in the 5-year plan?
Exactly. If you're a long-term believer in the AI story, if you believe AMD is going to capture, say, 10% of the AI market, then $192 looks like a discount.
You're not worried about a seasonal dip. You're looking at that 34% growth.
And you might look at $185 as a great buying opportunity.
But if you're worried about that valuation gap, that 74x PE,
then the smart move, according to this analysis, might be the wait-and-see approach. Wait for the stock to settle, let it test $185. There's no need to, catch a falling knife.
Catching a falling knife. I love that. You try to be a hero and buy the absolute bottom, but you're just likely to get cut.
Exactly. Let the knife hit the floor, let it stop wobbling, and then pick it up.
It's just so interesting how two people can look at the same report and see two totally different things. One sees a valuation trap and runs. The other sees margin expansion and starts buying.
Well, that's what makes a market. But I think the most crucial takeaway from this source material is that you cannot ignore the context. You can't just look at record revenue and assume buy.
And you can't just look at stock drop and assume sell.
Right. You have to understand why the disconnect exists. It's about the nuance. AMD is doing a great job running a business, but maybe the stock market got a little too excited about how quickly that would translate into world domination.
Precisely. They're improving, but they're being priced as if they've already arrived.
And the gap between improving and arrived is where all the volatility lives.
So let's wrap this up. We've got a company executing well, putting up record numbers, but getting punished for not being perfect. We have a valuation that is more expensive than the market leader, which is a huge red flag. But we also have this massive AI growth story that's just getting started.
That sums it up. A battle between strong fundamentals and just lofty expectations.
Here's a thought I want to leave you with. We talked about how weird it is that the number 2 player is more expensive than the number 1.
It's the central paradox here.
But what if the market isn't irrational? What if it's pricing in something we can't see yet? Is it possible that investors are willing to pay this premium for AMD, not because it is better than NVIDIA today, but because of scarcity?
Go on.
Well, think about the big tech companies buying these chips. They are terrified of being 100% dependent on NVIDIA. They need AMD to succeed. So maybe the market is pricing in a duopoly premium. Are investors betting that the world needs a second source so badly that they will pay anything to ensure AMD succeeds?
That's the provocative thought. Are we seeing a valuation trap, or are we seeing a security premium?
Okay.
If the entire AI ecosystem depends on AMD becoming a viable alternative, then maybe that 74x multiple isn't about current earnings. It represents the value of competition itself.
And that is the billion-dollar gamble. If the market is right, AMD grows into this valuation, and we look back at $192 as a steal. If the market is wrong, well, $160 might just be a pit stop on the way down.
It's definitely a situation where you want to measure twice and cut once.
Absolutely. Keep your eyes on those support levels. Watch the $185 mark. And remember, in this market, great is just the baseline. Thanks for joining us on this deep dive. We'll catch you on the next one.
Stay curious.
Don't forget to like, share, and subscribe for more.